Welcome to Silver&Metal IQ, the channel where we don't just talk about gold and silver prices, we break down why they move, who is really in control, and what smart investors see coming before the headlines catch up. I'm Peter, and today's discussion is not just another metals update. This is about a shift that's already in motion, and most people are completely unprepared for it. Let me start with something that should immediately get your attention. What if the biggest move in gold and silver isn't ahead of us, but already happening quietly, behind the scenes, while the majority is still distracted by stocks, crypto noise, and short-term headlines? Because that's exactly what the data, the flows, and the behavior of smart money are telling us right now. Gold and silver are no longer reacting like normal commodities. They're behaving like insurance, like escape valves from a financial system that's under more pressure than it wants to admit. Central banks are printing narratives while quietly accumulating gold. Industrial demand for silver is exploding, yet inventories are thinning. And at the same time, paper markets continue to price these metals as if nothing fundamental has changed. That disconnect is where opportunity and risk collide. Over the past few months, we've seen something unusual. Gold refuses to stay down even when interest rates rise. Silver shakes off sharp sell-offs faster than expected. These aren't signs of weakness. They're signs of underlying demand absorbing pressure. When markets try to push metals lower, buyers step in aggressively. That tells us one thing very clearly. Confidence in traditional financial assets is eroding, and capital is looking for something real. But here's where most people get it wrong. They think gold and silver move because of inflation headlines or Fed speeches. That's surface-level thinking. The real drivers are deeper. Sovereign debt levels that can never realistically be repaid, currencies losing purchasing power quietly year after year, and geopolitical tensions that make financial systems less predictable by the day. Metals don't panic, they prepare. And right now, they're preparing for something big. Silver in particular sits at the center of this shift. It's not just money, it's an industrial necessity. From solar panels to electric vehicles, from medical technology to advanced electronics, silver demand isn't optional, it's structural. Yet, unlike gold, silver inventories are being consumed, not just stored. Once it's used, it's often gone. That reality alone makes current pricing look increasingly disconnected from fundamentals. In this series, we're going to peel back the layers. We'll talk about what the mainstream media avoids, why volatility is not your enemy, and how smart investors think in phases, not days or weeks. This isn't about hype. It's about positioning yourself on the right side of a long-term trend, while others are still debating short-term noise. So stay with me, because in the next part, we're going to dive straight into why silver's recent behavior is alarming institutions, why paper markets are under pressure, and why the next move may not give latecomers the chance they're waiting for. This is Silver&Metal IQ, and what you're about to hear could change how you look at gold and silver forever. Silver's recent price behavior is making a lot of people uncomfortable, and not just retail traders. The real tension is visible behind the scenes, where institutions are starting to realize that silver is no longer behaving like a controllable asset. Every sharp dip is being met with aggressive buying, and every rally is exposing how thin the physical market actually is. This is not normal price action. This is pressure building. For years, silver has been treated as the weaker cousin of gold. Easy to suppress, easy to shake out, easy to scare investors away with volatility. But that playbook is starting to fail. What we're seeing now is a metal that refuses to stay cheap, even when macro conditions are supposedly negative for precious metals. Higher rates, stronger dollar narratives, risk-on sentiment. Silver is ignoring all of it. That alone should tell you something important has changed. The core issue is supply versus reality. On paper, silver looks abundant. Futures contracts, ETFs, derivatives. There's plenty of silver available if you believe paper promises. But in the physical world, inventories are tightening. Industrial demand is not slowing down, especially from solar, electronics, and energy infrastructure. Unlike financial demand, industrial demand does not care about price manipulation or sentiment. It needs metal, and it needs it consistently. At the same time, mining supply is struggling to keep up. Many silver mines are byproducts of other metals, meaning production doesn't increase just because silver prices rise. Add political risk, energy costs, and declining ore grades, and you get a supply side that simply cannot respond quickly. This creates a dangerous imbalance, one that paper markets are desperately trying to mask. This is where volatility comes in. Big sudden drops are not a sign of weakness. They are often forced events, margin pressure, algorithmic selling, or attempts to shake out weak hands. But notice what happens after these drops. Prices rebound quickly. Physical premiums stay firm. Delivery stress increases. These are not the signs of a collapsing market. These are the signs of a market being stretched. Gold is watching this closely. While gold moves with authority and stability, silver moves with emotion and speed. Historically, when silver starts acting like this, it's not the end of a cycle. It's the early phase of acceleration. Institutions understand this pattern very well, which is why positioning has become more cautious and reactive rather than confident. Another critical point most people miss is psychology. Silver is small enough to move violently, but important enough to matter. That makes it dangerous for systems built on leverage and confidence. If silver starts repricing higher in a disorderly way, it sends a message that paper pricing mechanisms are losing credibility. And once confidence breaks, it doesn't come back easily. This is why mainstream commentary keeps downplaying silver's significance. Calling moves speculative or temporary helps delay attention. But delay is not control. The underlying forces don't disappear just because they aren't discussed on financial television. As we move forward, the key thing to watch isn't just price, it's behavior. How fast dips are bought, how physical availability changes, how narratives start to shift from dismissal to justification. Those transitions always happen quietly at first. While public narratives continue to downplay gold and silver, the most important activity is happening quietly, away from headlines, away from social media hype, and far away from retail sentiment. The real story isn't what prices are doing on a daily basis. The real story is who is buying, how consistently, and without concern for short-term volatility. Central banks are at the center of this shift. Over the past few years, they have moved from passive holders to aggressive accumulators of gold. This is not speculation, it's strategic behavior. Central banks don't chase momentum, and they don't trade charts. They act when they see long-term structural risk. And right now, that risk is centered on currencies, debt sustainability, and geopolitical fragmentation. Gold, in this environment, becomes neutral collateral. It carries no counterparty risk. It does not depend on another nation's policy decisions, and most importantly, it cannot be printed. That alone explains why official sector gold buying has remained elevated even during periods when prices were already near all-time highs. When smart money buys strength instead of waiting for pullbacks, it tells you the objective is protection, not profit. Silver's story is slightly different, but just as powerful. Unlike gold, silver sits at the intersection of finance and industry. That makes it harder to stockpile quietly, but also more dangerous when supply tightens. Large buyers, particularly in Asia, are accumulating physical silver not as a trade, but as an input they cannot afford to lose access to. When supply chains become unreliable, price becomes secondary to availability. This is where East versus West dynamics become critical. Western markets are still dominated by paper pricing, futures, ETFs, leverage, and synthetic exposure. Eastern markets, on the other hand, prioritize delivery. Metal in hand matters more than contracts. This difference in philosophy is creating a slow but powerful shift in how price discovery works. As more physical metal flows east, it doesn't come back. Gold entering long-term reserves or sovereign vaults is effectively removed from the circulating market. Silver absorbed into industrial use is gone permanently. Over time, this creates pressure that paper markets struggle to reflect honestly. Price suppression can delay reality, but it cannot erase it. Another important signal is what isn't happening. Despite rising prices, we are not seeing panic buying from the public. There is no mania, no widespread fear of missing out. That's usually a sign we are still early. Major moves in precious metals don't begin with excitement. They begin with disbelief and boredom. Only later do emotions catch up. Institutional positioning also supports this view. Instead of heavy directional bets, we're seeing hedging behavior, optionality, and defensive exposure. That suggests uncertainty, not confidence in the current system. When institutions hedge against currency risk instead of equity risk, it tells you where they believe the real danger lies. All of this points to one conclusion. Gold and silver are being accumulated not because people expect immediate gains, but because trust in the broader financial architecture is slowly eroding. Debt levels are expanding faster than growth. Political risk is rising. Trade relationships are becoming unstable. In that environment, tangible assets regain importance. The key takeaway here is timing. Markets don't reprice gradually forever. Pressure builds silently, then releases suddenly. Those who accumulate before the release rarely feel urgency. Those who wait for confirmation usually pay much higher prices. To understand where gold and silver are headed, you first need to understand how their prices are managed, not just traded. Precious metals do not behave like normal assets because their prices are discovered primarily in paper markets, not physical ones. Futures exchanges, derivatives, and algorithmic trading dominate short-term price action, even though only a tiny fraction of contracts ever result in physical delivery. This creates an illusion of abundance. On paper, silver looks plentiful. In reality, the amount of readily deliverable physical metal is extremely limited. When prices drop sharply during low liquidity hours or around key technical levels, it is rarely because physical demand vanished. More often, it's because large volumes of paper contracts are dumped to influence sentiment, trigger stops, and reinforce the narrative that metals are weak. This is what manufactured volatility looks like. Sudden, aggressive sell-offs that occur without any corresponding increase in physical supply. These moves are designed to shake confidence, not reflect reality. Weak hands exit, strong hands accumulate. The cycle repeats. Gold experiences this as well, but silver is far more vulnerable because its market is smaller and thinner. It doesn't take much paper volume to move silver dramatically. That's why silver often looks chaotic. Sharp drops followed by powerful recoveries that seem to come out of nowhere. Those recoveries are physical demand reasserting itself after paper pressure fades. Another key mechanism is correlation engineering. During equity market stress, gold and silver are often sold alongside stocks, even though they are supposed to act as hedges. This is not natural behavior. It's the result of cross-asset algorithms forcing correlations where none should exist. When funds need liquidity, they sell what they can, not what they should. But here's the important part. Correlations don't last forever. When monetary demand for metals overwhelms liquidation selling, the decoupling begins. Gold usually leads. Silver follows, and often overperforms violently. This transition phase is uncomfortable because price action feels contradictory. Metals drop when they should rise. Sentiment turns negative right before fundamentals turn explosive. Backwardation in silver is one of the clearest signs that paper control is weakening. When spot prices trade above futures, it means buyers want metal now, not promises later. That condition exposes the fragility of paper pricing. Futures markets rely on confidence that delivery can occur smoothly. Backwardation signals that confidence is cracking. Another warning sign is the widening gap between physical premiums and quoted prices. If silver is cheap, but you can't buy it without paying a premium, the price is lying. Premiums are reality leaking through the paper system. They tell you where true supply and demand actually sit. This tension puts short sellers in a dangerous position. As long as physical supply appears sufficient, paper shorts feel safe. But once delivery pressure increases, exits become crowded. Shorts are forced to cover into rising prices, accelerating the move higher. These are not slow rallies. They are sharp, emotional repricings. The reason this matters now is timing. Many of the tools used to suppress or manage prices rely on stable confidence in financial markets. When that confidence erodes, through debt stress, currency weakness, or geopolitical shocks, those tools lose effectiveness. Paper promises become less trusted. Tangible assets regain their voice. The biggest mistake investors make in this phase is confusing volatility with weakness. Volatility is not bearish. It's a sign of transition. Calm markets indicate balance. Violent swings indicate stress. And stressed systems eventually break in one direction. To truly understand why gold and silver are behaving the way they are, you have to step back and look at the currency system itself. Precious metals are not rising because they are suddenly more valuable. They are rising because fiat currencies are steadily losing purchasing power. This is the uncomfortable truth most investors avoid. Every major currency today is backed by debt. Governments do not create money through productivity. They create it through borrowing. When deficits grow faster than economies, the only politically acceptable solution is monetary expansion. That expansion quietly transfers wealth from savers to debtors through inflation and currency dilution. Central banks understand this better than anyone. This is why, despite public statements about stability, they have been aggressively accumulating gold. They are not buying gold for yield. They are buying it for credibility. Gold sits outside the fiat system. It carries no counterparty risk. It is a neutral reserve asset in a world where trust is eroding. Silver benefits indirectly from this same dynamic. While gold anchors monetary confidence, silver acts as both a monetary metal and an industrial necessity. This dual role creates a powerful squeeze. When monetary demand rises at the same time, industrial demand remains strong. Unlike gold, most silver is consumed. Once it's used, it's gone. This creates a structural problem. You cannot print silver. You cannot mine it quickly. And you cannot replace it easily in critical technologies. As currencies weaken, capital looks for protection. Gold absorbs large institutional flows. Silver absorbs scarcity-driven panic. Another layer to this shift is de-dollarization. Global trade is slowly moving away from exclusive dollar settlement. Bilateral agreements, regional trade currencies, and gold-backed settlement mechanisms are being explored. This does not mean the dollar disappears overnight. It means its dominance slowly erodes. As the dollar's purchasing power weakens, commodities priced in dollars naturally revalue higher. Gold and silver are at the front of that line because they are monetary mirrors. They reflect the health or sickness of the currency system itself. This is why price pullbacks in metals during rate hikes or hawkish speeches are often temporary. Higher rates increase debt servicing costs. Eventually, something breaks. When it does, central banks pivot. Liquidity returns. Metals surge. We've seen this cycle repeatedly. Tighten, stress, rescue, debase. Each rescue requires more liquidity than the last. Each cycle leaves currencies weaker and metals stronger. The long-term trend is clear, even if the short-term path is volatile. Another critical factor is confidence. Markets run on belief systems. As long as people believe fiat money will hold value, metals remain alternative. But once confidence cracks, the perception flips. Gold and silver stop being hedges and start being necessities. This transition does not happen smoothly. It happens in waves, sudden repricings followed by consolidations. Each wave resets expectations higher. Each pause invites doubt, and each breakout surprises those who waited for confirmation. Silver, in particular, thrives in these moments. It lags until it doesn't. Then it moves fast enough to leave most participants behind. This is why silver bull markets feel uncomfortable. They do not reward patience in the conventional sense. They reward positioning before recognition. What we are witnessing now is not just a metals rally. It is a repricing of trust. Trust in currencies, trust in debt, trust in financial promises. Gold and silver don't need narratives. They respond to reality. As we bring everything together, one thing becomes clear. What's happening in gold and silver is not random, emotional, or speculative hype. It is structural, it is mathematical, and it is deeply connected to the way the global financial system is evolving right now. We've looked at shrinking physical supply, exploding industrial demand, backwardation signals, paper market stress, China and India's growing influence, and the silent actions of central banks. None of these forces operate in isolation. They reinforce each other. When multiple long-term trends align, price does not move gently. It reprices. That said, it's critical to understand that this journey will not be smooth. Precious metals never move in straight lines. Sharp rallies are often followed by aggressive pullbacks designed to shake out weak hands. Volatility is not a flaw in this market. It is a feature. And those who misunderstand volatility often mistake it for weakness. Silver, in particular, demands emotional discipline. It can surge when sentiment is bleak and pull back when confidence is highest. This is why most people fail to benefit from silver bull markets, even when they are directionally correct. Timing the exact top or bottom is not the objective. Positioning intelligently over time is. We are also entering an era where paper pricing mechanisms are being challenged. When physical demand overwhelms paper supply, prices eventually adjust, not because of opinion, but because of delivery constraints. History shows us that when confidence in paper claims erodes, physical assets assert control. Gold will continue to act as the anchor. Silver will act as the accelerator. Together, they form a powerful hedge against monetary instability, geopolitical risk, and systemic debt expansion. But they are not magic. They are tools. And like any tool, they must be used responsibly. One of the biggest mistakes investors make during strong trends is overexposure. Conviction should never replace risk management. Leverage magnifies both gains and losses. In volatile markets, patience and balance outperform aggression. Another mistake is chasing price. The goal is not to buy excitement. It's to buy value relative to long-term fundamentals. The strongest positions are usually built quietly, not emotionally. Markets reward preparation, not prediction. As we move forward, expect more headlines, more noise, and more attempts to explain short-term moves with simple narratives. But the real drivers are deeper: supply scarcity, currency debasement, energy transition demand, and the gradual loss of trust in debt-based systems. Gold and silver have survived every monetary experiment in history. They don't need central bank approval. They don't rely on algorithms. They don't default. They simply exist, and they wait. For those who understand this, the current environment is not something to fear. It is something to respect. Before we close, it's important to be clear and responsible. Financial disclaimer: this content is provided for educational and informational purposes only. Nothing discussed on the Silver and Metal IQ should be considered financial, investment, or trading advice. I am not a licensed financial advisor, and I do not know your personal financial situation, objectives, or risk tolerance. All investments carry risk, including the potential loss of capital. Precious metals markets can be volatile, and prices may fluctuate significantly. Always conduct your own research and consult with a qualified financial professional before making any investment decisions.